All right, that very highly anticipated rate hike is here. It happened here on Wednesday. I think this video I'll release tomorrow morning, but it happened. And this is something that a lot of investors have had their eye on because we've been at virtually 0% for almost 2 years now. In fact, the last time the Fed did a rate hike was over 3 years ago in December of 2018. And so what I want to cover on this video today is what exactly happened, the projections that Jerome Powell puts out. I want to go over some statistics, of course, my thoughts, and what this all means. And so first off, how did we get here? Well, the pandemic hit and kind of devastated our economy, so the Fed had to react quickly. They lowered rates to near zero, which allowed people to borrow money at very cheap prices. And so the idea behind that is that would flood the economy with more money. And we did see that reaction, right? The stock market over the last 2 years has been pretty impressive, except for now in 2022, but it really did do its job in what it was supposed to do. That's not to say there were still some hardships in other areas, but it did do its job. So now, with the rates being at zero, the effect of that is inflation. And we're at a 40-year high inflation, which means I've never seen this high of inflation in my entire life. And this was something that was unexpected. They even mentioned that inflation went higher than expected, so they had to react. So everybody here in the investing world was focused on the rate hikes today. Some said it was going to be 0.5%, some think it was going to be 0.25%, anything could have happened. But what really did happen and why are they doing this? It's to help, to offset the effects of this high inflation. So basically, the rates are up 0.25%. That's what they raised them today. Again, this is the first hike in over 3 years. The last time was December 2018. The Fed stated that they project 6 more rate hikes this year, one for every Fed meeting. And then in 2023, they expect 3 more rate hikes. And in 2024, they will do no more rate hikes. That is what they're projecting. And by the end of the year, this year in 2022, they expect rates to be closer to 2% when it's all said and done. And then again, they'll do the 3 more the year after. So 0.25 is really not that much. I think people are reacting to react. And I want to show this chart because I think it's very important to put things into perspective. And so if we look at the rate history, this is since 1950, you'll see that we are virtually at zero, and a 0.25 rate hike is still virtually at zero because you can see on the chart, most of the history it's been above that 2% mark, which is the benchmark that they want to get to. And so this is just to help put it in perspective. Of course, in the early 1980s, it was at its worst. Inflation went sky high. But right now we are at near zero, and a 0.25 hike is really nothing that I think is considered excessive. They're stepping into it very small because there's a lot of things going on, geopolitical conflicts across the world. And so outside of that, they are going to be reducing their balance sheet. So they'll be selling off their treasury securities, reducing their agency debt, and selling the mortgage-backed securities. So with the rate hike, they're also reducing their balance sheet, which they bought a lot of to help prop up the economy as well. So I want to go over some statistics and also what they projected out. So unemployment, they expect the unemployment rate to be at 3.5% by the end of the year. Right now, it's at 3.8%, which is equivalent to 6.3 million people without a job that are looking for jobs. In my home state of New Mexico, we're not doing good. We're at 5.9% unemployment rate. But their goal is their projections are that we'll be at a 3.5% by the end of the year, and now we're at a 3.8. And as I stated, the Fed is targeting a 2% inflation. That's their goal. So how are they doing? Well, let's take a look. Right now, the price consumer index, the general prices of everything, the number that you guys hear the most of is inflation is at a 7.9% growth year over year, which is a lot. If we look at gas, it's up 38% year over year. Of course, we all know this, right? Anyone who drives a car nowadays. Clothing is up 6.6% year over year. Vehicle repair costs are up 6.3% year over year. Airline fares are up 12.7% year over year, and rent is up 4.8% year over year. So there's a lot of work to be done to get to that 2% in, net across all of the different industries, sectors, whatever you want to call it. So what does this all mean? Well, borrowing is about to get more expensive. So you're going to pay higher price interest and higher prices on those loans that you take out. The idea of this is it's going to probably slow the economy down, right? As demand goes down because rates are going up, people aren't going to be borrowing as much money. This is them trying to cool off the economy. If you have a savings account, though, this should benefit you, unless if you're with one of the big banks, because the big banks tend to pay 0.01% interest no matter what, because they have a lot of money. They don't need that kind of draw to get people in. But you take high yield savings accounts like Ally Bank. I love Ally Bank and I use them. I think they're at a 0.5% now, so it's expected they'll go up to a 0.75%, maybe even a 1%. So if you have your money in a high yield savings account, that'll benefit your savings. Of course, hopefully we all put that rainy day fund aside, 3 to 6 months of your expenditures. And also, all this is happening to help reduce inflation. As we just stated, there's a lot of year over year excessive growth in a lot of different areas. And those things need to cool off because it's just going to hurt our economy the more inflation gets out of control. So this is what it's doing. Now, stocks went up with this news. They reacted positive. People expected the stocks to go down, and this is why you can't time the market. This is why averaging in, being in quality companies pays off, because the market reacted positively. And if we look at it, there's a reason why. So looking into Jerome Powell's speech, he did state that he expects 2.8% GDP growth this year, which is actually pretty good. If we look at the average, you will see here that since 1948 until 2021, the average GDP growth was 3.14%. So a 2.8 isn't that far off from it, and that's pretty healthy. It says the all-time high was 13.4% in 1950 and a record low of a negative 9.1% in the second quarter of 2020, hence when the pandemic hit. So as we can see, this is contributing to stocks going up, is that GDP is expected to be healthy. The other thing he mentioned that I think sent stocks rising is he does not believe a recession will occur. He does not think these rate hikes will cause a recession. And that, of course, is great news for the stock market because a recession is not a good thing, right? That's a very big slowdown of growth. And so I think that's why they're going with very small rate hikes at a time to ease into this hiking of rates and lowering of inflation, because the last thing you want to do is overreact and it really throw things off. So that's a good thing. That's why stocks are going up. So people were so fixated on the rate hike, and that'll be negative for the stock market, but I don't think they were thinking of what projections were going to be put forth, right? GDP is going to be good. They don't expect a recession. So you can't time the market because nobody can predict the future, nor what things will be said in meetings once they're released. So what are my thoughts on this? Well, honestly, this needed to happen. We needed rates to go up because inflation is hurting the economy. And if nothing was done, I think the market would, fall into a possible recession. I think it would have created a lot more red days in the market because the higher the inflation goes up, the more people are going to pull back on their spending. With a small increase in rates, now, if they went big, that wouldn't be good either. But with small increases, you're easing people into these rate hikes. It's not like getting a loan, now is going to be hugely different from getting a loan last week. There's going to be a difference, of course, but it's easing people into it so they have time to react, right? Hopefully people are becoming educated on this and learning, and if you're going to get a loan, sooner the better, because there are 6 expected this year and 3 rate hikes expected next year. But easing into it is probably the best thing to do. So I think that this is necessary. inflation is something that we need to get a handle on. And I think that with Jerome Powell stating that these rate hikes, in his opinion, in their projections, in their meeting, should not cause a recession is all good news for us investors, which means if you are a long-term investor and you continually invest, this is the positive to doing that, right? Is we can't predict things, but we can smooth things out by just investing regularly and riding the long-term trend up, because the market does always go up and has always recovered, right? So the last thing you want to do is let fear get in and you sell out of things, and something like today happens where the market went up and now you're like, darn it, why did I sell? So my opinion stays the same. My advice, as always, invest in quality companies, invest regularly, and just keep doing your research. And so I wanted to get this video out, a quick video on this. I think I'll be going over a portfolio review soon, so stay tuned for that. And if you're new to this channel, please subscribe. I think you'll like my channel. I post things regularly, and I have diverse content, quality content. I'm growing myself and trying to improve, so I appreciate if you join this journey with me, and thank you to all of those who are joining this journey with me. So have a great day, and we'll see you next time on Mark's Finance and Fitness.